Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, this probably isn't going to shock anybody who listens to this show regularly, but I tend to be a contrarian. Or as my mom put it, a nonconformist. I was the kid in college with the weird hair and black fingernails listening to new wave and punk music. And I gotta admit, I was called a weirdo more than once. But here's the funny thing about nonconformists. They're still conforming to something, right? I mean, I was maybe a weirdo to the average college frat boy, but I was perfectly normal in my circle of friends, right? We all dressed funny and listened to strange music together. So anyway, fast forward to today. I'm still a contrarian in a lot of ways, and I think most people in the mainstream investment world would agree with that. They would probably not call me a weirdo, although I guess they might, but I've definitely had the term gold bug thrown in my direction more than once. And by the way, when people say gold bug, they don't usually mean it as a compliment. But as I said, conformity or non-conformity is in the eye of the beholder. It's all relative, right? And if you were to drop me somewhere in Asia, my investment mindset is much more mainstream. They tend to be quote-unquote gold bugs over there. And we see this in the first quarter gold demand trends that were released last week by the World Gold Council. Demand for physical gold, I'm talking gold bars and gold coins, it surged in Asia during the first quarter. It was strong in a lot of other places too, but not in the United States. Believe it or not, demand for physical gold, bars, and coins actually fell in Q1. And it fell by quite a bit. So before I dig into those details, let me back up and give you kind of an overview of the gold demand through the first 3 months of 2025. Overall, total gold demand in the first quarter was the highest level since 2016. Now, that's not really surprising, right? Because we've seen this surge of gold prices. We've seen record after record broken. We've basically been in a gold bull market for 18 months, going on 2 years now. So the fact that demand was really strong in the midst of that, not a shocker. What is interesting, though, is to break down that gold demand and see where it came from and where maybe it was lacking. So as I mentioned, we had prices on a strong bull run hitting several record highs. Total Q1 gold demand, and this includes over-the-counter investment, came in at 1,206 tons. So that was the total demand for the first 3 months of the year. And of course, again, this is based on data compiled by the World Gold Council, which to some degree is estimated, but these are the best numbers that we can get. So 1,200 tons, basically, plus a little bit. So that was a 1% increase year on year, which doesn't necessarily sound like a lot, but the fact of the matter is it was building on a pretty strong first quarter in 2024. And when we look at demand in dollar terms, it was nearly $111 billion. That was just slightly off the all-time quarterly record. So when you combine the volume of gold demand with the rising price of gold, you see the value of the demand really spiking. The relative modest uptick in volume actually translated to a 40% year-on-year rise in the value of gold demand in Q1. Bar and coin demand, ETF inflows, and central bank demand were all really, really strong, which again isn't surprising given gold's gains over the last year plus. Also, unsurprisingly, high prices squeezed gold jewelry demand. In volume terms, we saw a 21% year-on-year decline in gold jewelry demand, and that was at 380 tons. However, if you, again, factor in the price increases, you get a totally different perspective. In dollar terms, demand actually increased by 9% to $35 billion. So in a nutshell, people spent a little bit more on gold jewelry than they did in the first quarter of 2024, but they didn't get as much for it, right? They're getting smaller chains, they're getting lighter rings, but they're having to pay more for it because, again, we're seeing this rapid increase in the price of gold. According to the World Gold Council, every single market except for China reported value growth in jewelry demand. Quote, suggesting that consumers were prepared to stretch their budgets in light of higher prices. Demand drag in the jewelry market was particularly notable in price-sensitive Asia. Chinese gold jewelry demand hit a 5-year low of 125 tons. However, the demand in dollar terms was down only by 6%. Looking at central bank gold buying briefly, net gold purchases came in at 244 tons. That was actually 21% below the first quarter of 2024, which was 310 tons. But it was 25% above the 5-year quarterly average. And again, part of the reason we're seeing a little bit of a decline year to year is because the first quarter of 2024 was so strong. As the World Gold Council put it, central bank gold buying remained, quote, comfortably within the quarterly range of the last 3 years. And keep in mind that central bank gold buying has been just booming over the last 3 years. Demand topped 1,000 tons for the third straight year in 2024. And to put that into some perspective, central bank gold reserves increased by an average of only 473 tons each year between 2010 and 2021. So we're seeing more than double the demand for central bank gold, again, over the last 3 years. When we talk about central bank gold buying, it's really important to note that these numbers represent gold purchases that are reported to the IMF. And the World Gold Council even noted in their report, akin to recent quarters, reported purchases only accounted for 22% of central bank demand in Q1, implying widespread buying interest beyond what was captured by the IMF FS data. This may be explained by a number of factors, including delays in reporting and purchasing by non-central bank official institutions. So we're talking about sovereign wealth funds, oil funds, and things like that. We can also explain this unaccounted for demand by countries, including and probably especially China, buying gold off the books. And it is likely that some central banks hold far more gold than they actually report. And Jan Nieuwenhuis has written some great articles for Money Metals digging into gold buying by China and really being able to show that they are buying far more gold than is actually being reported. I'll link to that in the show notes page. But looking at the official numbers in the first quarter, the National Bank of Poland was the biggest central bank gold buyer. And it was also the biggest buyer last year. It continued purchasing gold through the first 3 months of 2025, and it added another 49 tons of gold to its reserves. And some of the other significant buyers in the first quarter included China, Kazakhstan, Turkey, India, and the Czech Republic. So we're seeing this central bank gold buying primarily focused in emerging market banks. And we're seeing a lot of it in banks or in central banks that are interested in de-dollarization, that are worried about the weaponization of the dollar, that are trying to lower their exposure to the dollar so that they don't have to worry about being sanctioned or, having their reserves manipulated by the U.S. And again, as I've talked about often on this show, the United States does have a track record of using its privilege as the issuer of the world reserve currency as a foreign policy tool, and people are wary of that. And of course, we're also seeing increasing worry about the fiscal situation of the United States, this massive increase in debt. So de-dollarization is a thing, and that is really being reflected in this central bank gold buying. Of course, there is also demand for gold in industry and technology. That demand was relatively flat in the first quarter, came in at 80 tons. And that was despite a 2% increase in demand in the electronics sector. So let's dig into the physical investment demand, because that's really what I want to focus on, because I think it shows a really interesting dynamic, a really interesting dichotomy, the difference in the way investors in the East and the West think about money and investing. And as I've already mentioned, Asian investors primarily drove demand for gold bars and coins, as American investors continued to basically just sit on the sidelines. So looking at the big picture, global demand for gold bars and coins rose by a healthy 3% in the first quarter. It was 317.3 tons in the first quarter of 2024, and we had 325.4 tons of physical demand last quarter. And basically, it was comparable to the fourth quarter demand and a 20.3% increase from the third quarter of 2024. First quarter demand for gold bars and coins was 15% above the 5-year average. So overall, globally, very strong demand for investment gold, physical gold bars and coins. Now, if we break down the numbers by region, we find that China drove this surge in retail investment demand, and it charted the second strongest quarter on record. Chinese investors gobbled up 126.7 tons of gold bars and coins. So it's like a little over a third of total global demand came from China. That was a 47% increase from the fourth quarter and a 12% year-on-year rise. The World Gold Council noted that the gain was particularly impressive given year-on-year growth was built on already strong Q1 2024 numbers. According to the World Gold Council, quote, "The record-shattering gold price rally has been key in pushing up bar and coin demand during the quarter, with local assets such as equities and bonds underperforming. Investors flock to gold for returns." And again, we're talking about specifically Chinese demand here. Demand for gold was so strong in China that the government actually allocated additional gold import quotas for commercial banks last month. So basically allowing more gold to come into the country. The government very carefully controls imports into China. I'll link an article on the show notes page at moneymetals.com/news that will explain what I'm talking about here with these gold quotas. But basically, this is just a proxy for very strong demand. State Street Global Advisor strategist Aaron Chan described it as a, quote, multi-layered demand base in China, noting that it helps support and stabilize the price even amid extreme volatility. So this Chinese gold demand, and more broadly, Asian and Eastern gold demand, are really helping to support and stabilize the global gold market, as we are in a period of pretty high volatility. Even when you look at gold, we're seeing much bigger and more rapid swings in gold prices than we normally would. And that goes along with the overall volatility we're seeing around the world in stocks and bonds and in every other asset. Chan said this demand is less speculative and more strategic or culturally embedded, which means it is stickier and more resilient. Now, it's not just China. Indian investors are also continuing to buy gold, with coin and bar demand increasing by 7% year-on-year in the first quarter. It was the 7th consecutive quarter of year-on-year demand growth for gold coins and bars in India, which incidentally is the world's second largest gold market behind China. So we're seeing a strong uptick in physical gold demand in the two biggest gold markets in the world. Indian demand was down quarter on quarter, but this was primarily due to seasonal fluctuations and an inauspicious period in the Indian calendar. Indian gold buying is very much influenced by seasonal movements, festivals. There are times within the Hindu religion that it's good to buy, and there are times that it's not good to buy. So this is very much reflected in supply and demand dynamics in India. Looking at some of the other Asian markets, we also saw strong year-on-year increases in gold coin and bar demand. I'll just run through a few of these. Pakistan, 5% increase. Indonesia, 35% increase. Singapore, 35% increase. Korea, 36% increase. Thailand, 25% increase. Malaysia, 34% increase. So across Asia, we're seeing strong physical gold demand. We look over at the Middle East, which is another area that we typically find a lot of love for gold, just in general, in the culture and in the investment sentiment. Demand was basically flat in the Middle East in the first quarter. It was hovering just above the average level that we've seen over the past 3 years. Of course, that average level has been pretty high. According to the World Gold Council, Middle Eastern gold coin and bar demand growth was concentrated in Saudi Arabia, and that was driven by positive price expectations. It was also very strong in Iran due to currency depreciation, high inflation, and worries over unpredictable U.S. foreign policy. Remember what I said about the weaponization of the dollar. But in Turkey, higher interest rates kind of created some headwinds for gold, and so we saw a little bit of a drop-off in demand in Turkey as people shifted money into interest-bearing assets. And we also saw some price suppression on demand in the United Arab Emirates. Looking at Europe, there was also renewed interest in physical gold across the pond. We saw a 79% year-on-year surge in demand for bars and coins in Q1. Now, there's a caveat here because this came off of a very low base. In other words, Q1 2024, there was very, very low demand for physical gold. So what we actually saw was a 26-ton increase in demand in the European region. This was primarily driven by German-speaking investors. And we also saw a little bit of a demand boost in the United Kingdom as investors sought capital gains tax-compliant gold in light of last year's budget changes to the capital gains thresholds. So looking at North America, even Canadians got in on the act. Gold and bar demand surged in the Great White North by 85% year on year. So, you look at all these different regions, Asia, physical gold demand just booming. Europe, I wouldn't say it's booming, but there's been revived interest. Canada, strong gold demand. Mexico, strong gold demand, physical gold bars and coins. And what about the U.S.? Well, gold coin and bar demand dropped to the lowest level in almost 5 years. So while Asian investors piled in gold, European investors rediscovered gold, Canadians bought gold, Americans, they sold, seeking profits, I guess, given the higher prices. So who are the contrarians in this scenario? It's the American investor, right? The Asians and even the Europeans right now, they're the gold bugs. So total demand in the U.S. for coins and bars was 19.3 tons. That was a 22% year-on-year drop and a 16% quarter-on-quarter drop. Now, World Gold Council analysts said the drop wasn't very surprising given Trump's transition into the White House. Quote, historically, Republican presidencies have generally resulted in lower retail demand. However, fieldwork suggests that investment interest picked up late in the quarter and continued through early Q2 as tariff announcements dominated the headlines. And I think this is pretty valid just from what I've observed over the years. Your gold bugs in the U.S., the people that are most interested in physical gold, coins and bars, tend to be more conservative or libertarian leaning people. And so when a Republican is elected, there's more optimism that the economy is going to do well, that the policies are going to be more friendly, that the economy will be strong, and therefore they don't feel the need to hedge with gold and silver. Gold and silver is typically viewed as a safe haven asset. And I think a lot of people thought, well, we're going to have Trump. We don't need a safe haven. Now, personally, I think that is a foolish mindset because, first off, in my observation over my, 58 years on this planet, I've found that administration to administration, there's a lot of things that tend to stay the same, and that's borrowing and spending. That is, reckless monetary policy, which really doesn't have as much to do with the administration as it does the Federal Reserve. The policy, the stated policy of our central bankers and the government at large is that we need to depreciate our currency 2% every year. I've said this over and over again. Inflation is not an accident. It's not something that just happens. It is a policy. 2% inflation is built in. It's an ingredient in the cake. So you always have to keep that in mind. I think it's always important to have some gold and some silver in your portfolio. And the fact of the matter is, a lot of American investors do not. They buy gold when they think there's a problem, when they're worried, and then they sell it and they go on their merry way. And I would argue that they're missing an opportunity to preserve and protect their wealth, especially if that money is just sitting in cash somewhere. If your money is sitting in cash, you are losing money in most places, even if you're getting an interest rate from it, because your interest rate is not keeping up with the real interest rate, which factors in price inflation, which again is the policy. Now, to be completely fair, American investors didn't spurn gold completely. While we saw a big drop in physical gold demand, there was a increase in ETF demand, and gold flowed into North American-based ETFs, with fund holdings increasing by 134 tons in the first quarter. Now, keep in mind, some of that ETF demand in North America likely came from Canadians who, as we've already noted, flocked to the yellow metal in the first quarter. But strong ETF investment in North America nonetheless. And along those same lines, Asian investors are starting to show more interest in ETFs. And as a result, we saw a really strong increase in ETF demand in the first quarter globally. Big inflows of gold during the first quarter. And this helped run overall investment demand, so when you consider both physical and ETF investment, all the way up to 552 tons. That's a 170% year-on-year increase, and it was the highest level since the first quarter of 2022. Just looking at the ETF demand in dollar terms, we had $21 billion of inflows, and that was the second highest quarterly inflow on record. It was just $3 billion lower than the record inflows that we saw during the second quarter of 2020 during the government pandemic shutdowns. And as the World Gold Council put it, Asian ETF demand stood out, rising by 34 tons in Q1. So this wasn't just North American ETFs. As I mentioned already, Chinese, Asian investors, they're starting to become more interested in ETFs. The bulk of Asian ETF demand was for funds listed in China, and India also showed strong gold growth with 11% increase over the period. Now, you might think that gold is gold, right? And there really isn't much of a difference in investing through an ETF or buying physical metal. And it's not really true, right? They're different. ETFs and physical gold are two different things. They're different types of investments. Closely related, mind you, but not the same. ETFs are a really convenient way for investors to play the gold market. What is an ETF? It's basically a fund. It is backed by physical metal, and it is traded on a stock exchange. So you can go to, your Robinhood and invest in gold ETFs. Again, they hold gold. They're backed by gold, and therefore they tend to track with gold over time. But owning an ETF is not the same as holding a physical bar or a physical coin. And, don't get me wrong, I'm not anti-ETF. They have their place in the investment world. But again, it's not the same as having gold in your hand. When you choose only ETFs, if that's your only exposure to gold, you're introducing some level of counterparty risk. So why do people like ETFs? Well, they're convenient, right? They're relatively liquid. You can buy or sell an ETF, just with a few mouse clicks. You don't have to worry about transporting or storing metal or shipping or any of that stuff. In a nutshell, it allows investors to play the gold market without buying full ounces of metal at the spot price. Since you're basically just buying a number in a computer, you can easily trade ETF shares for another stock or for cash whenever you want. You can even do it multiple times in the same day. So as a result, a lot of speculative investors like to take advantage of this liquidity, right? You can buy low in the morning and sell high in the evening, and you're not trying to move physical metal around. However, while a gold ETF is convenient, and it's a way to play the price of gold on the market, you don't possess any gold. You don't own gold. You have paper, right? You have numbers in a computer. You don't know for sure that the fund has all of the gold either, especially when the fund sees inflows. So, you get such, in these scenarios, there have actually been difficulties or delays in obtaining physical metal. So you're really putting another party in between you and your gold when you're investing purely in ETFs. Again, I'm not against it, but in my opinion, you should hold physical metal first and then use ETFs as a way to supplement your investment, or to maybe play the market on a more day by day basis. But if you're holding gold and silver for the long run, I think it's better to have that physical metal. Anyway, I find the fact that this gold bull run has, for the most part, happened with U.S. investors on the sidelines, with physical bar and coin demand in the U.S. actually down. It will be really interesting to see what happens when U.S. investors get in the game. And I think they ultimately will. Again, the World Gold Council is already seeing signs of this in their field work. So, we've really seen a gold bull market. And this has been true since early in 2024. It has been primarily driven by central banks and demand in the East. And, it's interesting because I think it goes to a mindset. There is a different mindset towards gold and silver, precious metals in Eastern markets. They value it more highly. They recognize it as money. And I think in the U.S., because we issue the reserve currency, we think dollars are king. And I think if you ask most Asians, they'd be like, no, I would much rather have gold and silver. Regardless, right now, Americans are more in a selling mood. Speaking of which, I wrote an article over at moneymetals.com/news that was based on an article that I ran across in the Financial Times out of England. And it was talking about the big increase of people selling scrap gold over there. So in other words, they're seeing these high gold prices, and they're looking in their drawers, and they've got these old gold chains, and they've got some old bracelets or rings. Nobody's wearing them anymore. And they're thinking, well, maybe I can make a little money off this, right? So they're going to the pawn shop, they're going to the gold dealer, and they're trying to sell that scrap gold to make a few extra bucks, or in the case of the Brits, a couple of pounds. And, if you're thinking about selling gold, you might be too. I mean, this isn't something that is, particular to England. Your first question is probably going to be, how much money am I going to get for it? And I will bet you that a lot of the people that, grabbed those old gold chains and rings were disappointed. I remember years ago, after I got divorced, I decided I was going to sell my old wedding ring. And, I kind of had a number in my mind of what I thought I might get for it based on the price of gold that I had seen. So I went off to a dealer who bought scrap gold, and the offer that I got wasn't anywhere close to what I had in my imagination. And that's probably because that ring was 14 karat gold, right? It was much less pure. And American gold jewelry tends to be less pure than, say, a gold American Eagle, right? So what are we talking about when we're talking about gold purity? Well, as you probably know, gold purity is measured in carats. And each carat represents 1/24th of the whole. So in other words, if you have an 18 karat gold ring, it's 18 part gold and 16 parts other metals. So it's basically 75% gold. It's not pure gold. However, if you pick up an American Gold Eagle, you'll see on it, it's like 0.999% pure. It is pure gold. In the carat system, 10 karat gold is the minimum standard in the US, and that represents about 41.7% gold. So that 14 karat gold necklace that you're hoping to sell is really less than 60% gold. And that's why you're going to get much less per ounce than you might think when you say, oh, I've got this gold ring. Interestingly, 24 karat jewelry is much more common in Asia, where it's viewed much differently in the West. I mean, jewelry is viewed much differently than it is here in the West. Jewelry is not just an adornment. It is an adornment, and if you see Indian women, they're very often wearing gold. It's a very much a part of Indian culture, but it is also an investment. For instance, a lot of Indian jewelry is made from pure 24 karat gold, as opposed to the 14 and 18 karat pieces that are more common in the US and Europe. And many Indian families use gold jewelry as their savings, right? They're literally wearing their savings around their neck. They're wearing pure gold chains. On a side note, we actually sell some high purity gold jewelry over at Money Metals. You can check that out over at moneymetals.com. But that's kind of a difference. Again, we have this different mindset between the East and the West. We have this different mindset between Asians and Americans, and it's reflected in this gold demand. And again, I think, ultimately, Americans are going to catch up with this because Americans do value gold in times of crisis, right? We saw that during the 2008 financial crisis. We saw it during the pandemic, and we're going to see it when the next crisis comes, which, as I've been saying, I think is around the corner because we've got this bubble, debt-riddled economy that is just looking for a pin to pop it. And, tariffs may have been that pin. But even if tariffs aren't, that pin's out there. The bubbles are out there. That's the reality. And I think when that happens, that's when you're going to really see American investors and European investors to a greater extent get into gold. But regardless, I'm not sure I'd be cashing out my gold right now. In fact, I'm not cashing out my gold right now. I'll be quite honest with you. Clint Signer, who is a director at Money Metals, he wrote a really good article making the case that now is not the time to sell. And I'll link to that on the show notes page as well. But hey, if you want to sell, if you need the money, if you believe it's time to get out, then we will buy your gold coins and bars here at Money Metals. So whether you're interested in buying the dips as we see, the price fluctuations, we had a pretty significant dip earlier this week and then a big rally yesterday. But those dips to me are buying opportunities. But regardless, again, you can buy or sell at Money Metals. All you have to do is call 800-800-1865, talk to a Money Metals, precious metals specialist, and they can explain how we buy gold if you want to sell. They can help you if you're interested in buying, figuring out what products will work for you, how gold can fit into your investment strategies. These folks are fantastic. Use them. That's what they're there for, and they'll be happy to talk to you. Now, of course, I know a lot of people don't like to talk on the phone, which is cool. You can go to moneymetals.com, and you can just chat online with the precious metals specialist. Or, again, if you know what you want, you want some of those American Gold Eagles, you want silver bars, you want to get some high-purity gold jewelry, you can find all of it online and buy right from the website. So do that today, because now's the time. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up and get on our email list. Of course, you can subscribe to this podcast, Midweek Memo, on your favorite podcasting platform if you haven't done that already. And make sure you tune into our Market Wrap podcast every Friday as well. You'll be able to do that with the same subscription. You'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. Last week, I talked to Jim Grant, which was fantastic. If you like the show, thank you so much for listening. If you enjoy what we're doing here, please go to wherever you're consuming the podcast and smash the like button, leave a positive comment, share these episodes. It helps us grow the show and helps us keep going and get bigger. So again, thank you so much for listening to the show. I hope you have a fantastic rest of your week. We'll be hearing from Jerome Powell later today, so that'll be interesting. So again, thank you so much, and we'll talk to you again next week.